returns around the earning dates. Once Christian completes the presentation, we will have the Q&A session. You can type in your questions during the course of this webinar in the Q&A box on your screen at the bottom, and we will try and take as many as possible post the presentation. With this, I request Christian to take us through the presentation. Over to you, Christian.
Thank you so much, Alok. A very good evening to everyone who is dialed into this particular session. Again, very happy to share that we have approached the 1-year anniversary of since we launched this product. So we launched this product, October 25th of October last year, and in time flies, we have almost reached the 1-year mark. Right, so I'm really grateful for everyone for your support, people who are dialed into this call, or all our existing investors. Okay, so just to move on, firstly the disclaimers. Please note that investment in securities are subject to market risk, and you should read all scheme-related documents carefully before investing. And the figures and the returns and other data which we will discuss today are just for your illustration and understanding only, and they do not guarantee any future returns. So with that, just to get into what we want to discuss today, which is an interesting topic, right? Because it kind of goes into our one of the aspects of why we select undervalued and profitable companies, right? Which is what we do in MeritorQ, which is our selection step, right? So maybe just to start out with an example. Imagine you've ordered some apples or any of your favorite fruits, right? And it could be the fruits which you see on this slide. What would you prefer? Would you prefer a rotten apple in an expensive crate or a bag, or a good quality apples in a cheap crate, right? I'm sure, and obviously your answer would be the latter. But why? Because it's because again, good quality cheap crate doesn't really matter what bags it comes in. What you really care about is the apples, and as long as you're getting good quality apples in whatever bag you get, it's still value for money, right? So that's the a very normal choice, right? Now similarly, when you are pursuing an investor who is pursuing value for money strategy, right, in stock markets, it can help the investor generate a better risk-adjusted return and provide wealth creation opportunities, right? So when you think about the same value-conscious approach, right, which nearly all of us would follow in other walks of life, you take that approach and you follow this, in stock markets, it can reap, very good rewards. So this is the subject of today's webinar. Now, before we get into the why of why this works, recall that in MeritorQ, right, we select 30 to 45 undervalued yet profitable companies which meet our criteria for clean accounts, low leverage, and consistent profitability. In MeritorQ, value is measured by comparing the free cash flow generation ability of the company versus the market price of the company, right? As we have discussed before, free cash flow is essentially the cash flows which is remaining after the company has paid all its operating expense, its capital investments, as well as its working capital spent. So essentially, it's the cash left with the company, which is remaining. Essentially, if you think about cash in the pocket, right? Essentially, this is the cash which is left in the pocket of the company, and which is available to either be distributed as dividends, or which is available to be further grow the business, right, in whatever way the company wants for new growth initiatives. So, and if you have two companies, just to take an example, which both the companies say are trading at a market price of say 100 rupees, and one has a free cash flow of say 20 rupees, other has a free cash flow of say 80 rupees, right? We prefer the second company versus the first company. So that's a very simple way of for us to say how we look at value in MeritorQ. Essentially, we are looking at companies which are able to generate good free cash flows versus the price we are buying that company for, right? And we have again discussed it in one of our previous webinars on why free cash flow based valuation measure, which we are employing in MeritorQ, is superior compared to some of the other relative valuation measures, like price to earnings, EV to EBITDA, price to book, so on and so forth. And there are various reasons. I won't get into that here, but again, this is the valuation measure we are using, right? And the final selection step in MeritorQ is achieved by again ranking companies independently across this price to free cash flow. And in case of financials, we use price to book and profitability, which is you can use a proxy like return on capital employed, right? And companies which are both profitable as well as relative valued, so they need to be good on both. They need to be undervalued as well as profitable. We select those companies. So this is represented pictorially in the quadrant, the four quadrants you see on the right side of the slide, right? So the bottom right quadrant is what we are calling as the quality at a reasonable price quadrant, right? Why? Because that quadrant essentially represents companies, right, which are both profitable, on the return on equity or return on capital employed, and which are undervalued basis price to free cash flow for non-financials and price to book for financials, right? So this is what we are selecting in MeritorQ. This is our ownership zone, or the companies we are targeting in MeritorQ, right? Of course, again, we have tried to simplify this because we are just looking at the selection step here and trying to examine that in detail, at least for this webinar. But remember that in MeritorQ, like I said, it has additional screening steps, right? So, the quality dimension is not only captured only basis profitability, right? Just to be clear, we are looking at, again, the cash flow conversion, capability of the company. We are also looking at, different dimensions which look at the company's, whether the company is, again, disclosing its accounts in a fair manner, essentially using forensics. And we are also looking at consistency of profitability as well as the leverage, essentially the debt, how much debt the company has, right? So even if a company, has, is seen as, cheap as well as it is profitable, if it doesn't pass some of our other screening steps, it will not make it into the bottom right quadrant, right? The quality at a reasonable price quadrant in MeritorQ, right? But for the purpose of this analysis, right, at least for examining the selection step in detail, all we have done is we have taken all the BSE 500 companies, right, and divided it equally among these four buckets, right? Just to show you why this makes sense, right? Why this call it, selecting stocks which are both profitable and which are undervalued, why that works. So the bottom right quadrant, like I said, is the quality at a reasonable price quadrant. The uh, the exact opposite quadrant, which is your top left quadrant, is your unprofitable and expensive companies, right? Now these are again companies. I don't need to again get into how we've defined it, etc. I think it's the exact opposite of the merit, the quality at a reasonable price portfolio. So essentially, if you think about what these two portfolios represent, right? Essentially, these are the polar opposites, and both these portfolios, what they mean is essentially the price is disconnected from the fundamentals, right? So for companies which are unprofitable, essentially we are saying that these are expensive, right? So the price is completely disconnected or completely is diverged away from the fundamentals. Similarly, for the bottom left quadrant, quality at a reasonable price, here again we are saying that these are good quality companies, fundamentals are sound, but the prices have again gone below their fundamental value. Essentially, these are undervalued, right? So again, there is a divergence from the fundamentals, right? So for these two portfolios, the mispricing, right? The market is mispricing, and the mispricing is the maximum, right? So, and also the bottom left quadrant, right, which you would see as, what we are calling as value traps here. Again, these are companies which, again, I don't need to get into, why they're being called value traps. Essentially, these are companies which are undervalued, but the undervaluation is there for a reason, right? The fundamentals are poor. In this case, we are looking at profitability. So essentially, they're unprofitable companies, and the market is saying, we don't think, we should be paying a higher price for these companies, right? So, that those being the definitions of the different regions, right? In this, how we are dividing, the entire 500 companies from our investment universe, which is basically our BSE 500 or a Nifty 500 investment universe, right? So one of the key questions, right, is so I'll maybe just keep it to here before we get into the next slide. One of the key questions is whether the higher average expected returns, right, which you see with undervalued, which you see when you buy undervalued companies, or the low average expected returns, which which someone can expect when they buy companies which are too expensive, right, which are overvalued, are an outcome of mispricing or due to transient factors like some short-term negative news or temporary business slowdown or an industry being out of favor, or is it an outcome of taking higher risk of buying undervalued companies, right? So essentially, whether this in one of our previous webinars when we discussed valuation, we discussed, if you buy undervalued companies, essentially you end up earning higher risk adjusted return, right? So and that we also saw that a higher risk adjusted return is also sustainable, right? So it's not just persists for a year but over multiple periods, right? So the question is this a result of maybe buying more riskier companies, or is it due to mispricing? Essentially, like I said, right, for the companies in the bottom quadrant and in the top left quadrant, is this mispricing due to the disconnect between the fundamentals and the the market prices? So we would expect, because if there is a mispricing, remember at some point in time this mispricing needs to correct, right? We don't know when it will correct, but it has to get corrected at some point, because again markets and again market participants are rational, and at some point whenever the temporary negative news or whatever reasons the market prices have been marked down, whenever that subsides, the price should get connected to the fundamentals, and the share prices should appreciate to the right level, right, which is representative of the fair value of the company. Now, so essentially, if indeed this is the case, we should see meaningful returns, whether it's positive or negative, when the share prices are more disconnected for companies, right? So for companies, again, in the top left quadrant, you should see negative returns, going forward when you select these, such companies. Similarly, for companies which are in your quality at a reasonable price quadrant, you should see positive returns, right? Essentially, whenever the mispricing gets connected, right? So like I said, so this entire construct, here we have shown just to show this concept, right, that how we are going about testing this hypothesis, right? So you just take all the 500 companies from the BSE 500 universe, or which is our investment universe, divide it into equally among these four quadrants, basis valuation and basis profitability, and we do this every year, right? So as to check these the returns of such a strategy. So we divide them into these four quadrants every year in September, and then we look at the returns of the strategy over the next 1 year holding period, right? So the returns are calculated over 1 year holding period, and again this portfolio is rebalanced. Again, all the 500 stocks are distributed into these four buckets every year, and we do this from September 2006 to August 2023. And again, please note that whatever analysis we will show, and we'll show this analysis in the next slide, whatever analysis we have done is based on point in time data, right? So we have used the valuation as well as the profitability of a particular, of the BSE 500 constituents as of that particular date in history, and the profitability and valuation as of that particular date in history, right? And we have also included firms which have got delisted, merged, so on and so forth. So in a way, we have tried to minimize any kind of survivorship bias or any kind of look ahead bias in this, whatever results we are going to show you. So, what do the results look like, right? So this slide essentially summarizes the results, right? The performance of each of this quadrant portfolio, which we discussed in the previous slide from September 2006 to August 2023. Remember that again, all the portfolios, all the 4 quadrant portfolios, they are equal weighted, right? And like I said, we form this quadrant portfolios once in a year in September. We hold it for a year, and again we repeat this exercise, right? And we do this over almost a 16-year period from September 2006 to August 2023. And please note that again, all the returns which we will discuss are in price return terms and gross of any fees, brokerage, or any other transaction cost, right? So what you see here is, as you would expect, right? The 2 most mispriced portfolio, the top left portfolio, which is your expensive and unprofitable companies, and your bottom right portfolio, which is your quality at a reasonable price, have the lowest and the highest return respectively. And like I said, these are the 2 portfolios or 2 strategies where the mispricing, the disconnect between the valuation and the fundamentals was the highest, right? So as this mispricing gets corrected, so for the companies in the bottom right quadrant, the share price is getting corrected downwards, so they are underperforming, right? And companies which are in your quality at a reasonable price, essentially your bottom right quadrant, your mispricing is also getting corrected, so their share price is actually appreciating, right? So they outperform. So these results again are not uh, surprising, right? Uh, so again, note that the quality at a reasonable price quadrant not only has the highest return, it has a CAGR of 16.2%, as you can see, over this almost 16-year period versus 10.8% for BSE 500. This is almost a spread of 5.4%, right? Versus a negative alpha of 7 percentage points between for the unprofitable and expensive quadrant, right? Not only is it this, but the risk of this portfolio, and when we say risk, it is the drawdown we are looking at here. Remember again, I think we have said this repeatedly. What investors should care about, when we think about portfolio risk, is the risk of loss of capital, right? And the drawdown comes as close as possible when you think about loss of capital. And that's what we have shown, right? Essentially, we are just looking at the maximum drawdown, right? So, when you look at, again, drawdowns over the 16-year period for each of the strategy, and you look at the maximum drawdown, right, for each of the strategy, this is what you would find the second column here, which is what we have jotted down just on that small block, right, just above this chart. And what you would notice there is, again, the quality and the reasonable price portfolio has the lowest drawdown. In fact, it has a lower drawdown versus the benchmark, 64.3% versus 66.4%. Whereas the other mispriced portfolio, which is your unprofitable and expensive companies, has the highest drawdown of around 80%, right? So again, no surprises, as you would say, but essentially that means is not only is this quality at a reasonable price quadrant, which is the kind of quadrant where we are selecting stocks in MeritorQ from. Not only does it have the best performance in terms of forward-looking performance, it also has the lowest risk in terms of drawdown, right? So while you might argue that maybe what is what is the portfolio, what is the real measure of risk? What we think is in MeritorQ, when we are selecting undervalued and profitable companies, right? In a way, that itself is the best metric which reduces your forward-looking risk, right? As well as drawdown of investors' wealth, right? So this is what again ensures that a strategy like this, a selection strategy which you are employing in MeritorQ, has the best risk-adjusted return. Again, when you look at performance or returns over a longer horizon, right, over a 16-year period. So again, in the previous slide, we looked at again, portfolios or, a strategy which, where we are again putting, we're classifying companies into those buckets once every year in September. Uh, but, someone could rightly argue, right, that, you know, uh, a 1 year time frame is generally quite short. And over a 1 year time frame, it could happen that a cheap stocks could always get cheaper. Similarly, expensive stocks could always get more expensive before the reversion to fundamentals occur, right? So what we are trying to show on this slide is, if you just take, the construct which we explained, in the last slide, and we just look at the rolling returns of that quality at a reasonable price portfolio, but instead of holding it for a year, you hold it for, more time, right? You just extend the holding period to 2 years, and maybe you just even hold it for 3 years, and in between you don't do anything, right? You don't do any rebalancing, whatnot, right? So essentially, this is for someone, again, who has a longer term horizon. So essentially, almost a buy and hold strategy, but instead of rebalancing it every once in a year, you just do it every once in 2 years or every once in 3 years, right? So again, what you see is, while most of the gains, right, from this reversion or this correction in the mispricing for this quality at a reasonable price portfolio is likely to be realized in the first year itself, right? So the first year, just holding it for 1 year, which is what we showed you in the previous slide, that itself generates a 3 year rolling return of around 17%, right? 17.2% to be exact. You can see that holding it for 2 to 3 years, right, just extending it by 1 year, to 2 and 3 years, uh, in fact, your returns increase, right? They're higher than a 1 year holding period, which means that the reversion to fundamentals is not, a temporary phenomena, right? These are sustained, right? So essentially, what is happening is, you caught the mispricing, and the share prices are now reverted to fundamentals. But in many cases, maybe it has happened over, a longer period of time, and when this happens, generally this reversion is sustained, right? So it's not as if, if you hold it for 3 years, 2 years, again after that, the again the prices fall down, or this is a temporary phenomena, right? So this affirms why we believe MeritorQ's objective of buying quality at undervalued companies can earn attractive risk-adjusted returns for long-term investors, right? So even if you have a 2 to 3 year horizon and you don't want to touch the portfolio, right? You just take the portfolio from us. Ideally, you should rebalance, right? Because that obviously adds to the overall returns of the strategy which we have shown. But again, to the point, at least for this discussion, this reversion to fundamentals or a selection strategy holds even over a longer term, right? So not necessarily over 1 year. Okay, so in the previous two slides, again, at least the slide before this, and the 2 slides before this, we looked at again quadrant portfolios, right, where essentially each quadrant is roughly holding around 125 stocks. Because remember, we just took the 500 stocks, we just divided it equally among the 4 quadrants. And someone again could argue that 125 stocks in a portfolio is too large for a practical, actively managed strategy. So why not again, look at the results at a more granular level, right? So what we have done is just broken this up again at a more granular level, where we've divided, again, the profit, along both profitability and valuation, we have divided the entire 500 stock BSE 500 universe into 25 such blocks, right? So we have divided into 5 blocks on profitability, and then 5 blocks in terms of value or valuation, right? And again, using the same measures of valuation, profitability we talked about. So each bucket here, or each block here, has roughly around 20 stocks, right? So 500 divided by 25, which is roughly 20 stocks. And like I said, 5 buckets, or 5 equal buckets on valuation. So, as you go from, your top to bottom, you're going from relatively overvalued to relatively undervalued, basis price to free cash flow or price to book. And similarly, as you're going from left to right, you're going from the least profitable to the most profitable, right? So returns of this, again, this quantile, we can call this quintile portfolios, because each of them contains 1/5 either on profitability or valuation of the overall universe. So returns of this quintile portfolio is calculated in the same manner as we do, for the quadrants. Each of this quintile portfolio is equal weighted. And the only exception here is we are looking at the excess return, right? Essentially the returns over BSE 500 index, right? So whatever numbers you see here, essentially these are the returns for each of the portfolios over holding it for 1 year, so on and so forth. And we do this over 2006 to 2023. But the returns are again stated in excess return terms. Essentially, this is basically alpha over BSE 500, and so that we can observe more clearly what is the impact of selecting again companies basis profitability and valuation, right? So again, you can see that the mispriced portfolios, right? So essentially, I just highlighted this, in those two rectangles which you see here. The two mispriced portfolios, the top left, bottom right, they have the highest return. So we've just taken the averages. So we just take the average of, for example, the bottom right portfolio, which is your quality at a reasonable price. That has an average return across all those, the bottom four blocks. That average is around 6.9%, right? So the share prices of these companies, on an average, they have delivered an alpha of around 6.9%, over this 16-year period we are observing, right? Similarly, your the top left portfolio, which is again the most overvalued as well as expensive, essentially the most mispriced portfolio, on the other side, that has delivered a negative alpha because the share prices again have depreciated, right? So they have come down. So that has delivered a negative alpha of 9.4%, right? So on an average, the spread in alpha, if you think about it, is around 16.4%, which accounts for most of this difference, when you look at the difference in terms of the valuation, right? So as you go from top to bottom, the overvalued to the undervalued, you can see that the average returns, which is basically your average of the Q1 in terms of the Q1 which I've highlighted, essentially the top row and the bottom row, which is the average of the top row is basically the average of your most expensive or most overvalued stocks. That's around minus 5.3%, and the bottom row, that's the average of your most undervalued stocks is around 8.1%, right? So the 16.1% which you see, right, which is the difference in alpha between the two mispriced portfolio, that is basically driving this, the alpha of this valuation, between the overvalued and the undervalued companies, right? Which I think we discussed in a few webinars before this. So again, the point being that this mispricing is the driver of this difference in returns due to when we pick undervalued companies, right? So if you think about it again, again what we are saying is, you know you don't earn alpha by just picking undervalued companies, right? You earn alpha essentially by picking companies, undervalued companies, which have good fundamentals. And having that fundamental and looking for companies with good fundamentals is a very, very important step, right? So again, that's the crux of again this argument we are trying to make. And I think this slide, what we are trying to say brings out this aspect clearly, hopefully. So with that, let me move on to the almost the last slide for today's discussion, which is again what we did is one way for us to check this hypothesis, right, which we came up with, that companies which are more mispriced essentially should see the the best correction in terms of correction of the mispricing or the reversion to fundamentals, right? So one way to check this is to look at the performance of these companies at earnings dates, right? Quarterly earnings date, because if you think about it, at the earnings announcement date is when companies generally update their investors on their financial and business performance, right? So what we did is we look at the the market adjusted or the benchmark adjusted returns around these dates to provide an indication if investors are correcting their expectations for mispriced companies, right? So if, for example, these companies are genuinely mispriced, generally what you would expect is at around earning state, right? This mispricing should get corrected, right? Because again, earning states, again, like I said, right, are the window, through which investors realize that a mispricing has happened, and then the correction happens. As they realize that these companies have good fundamentals, and whatever negative issues the company had faced, that's no longer there, or the company is actually marked much lower than where it should be. The share prices are marked much lower than where they should be. And again, this is done to further validate our arguments that mispricing and subsequent reversion to fundamentals is one of the key drivers of returns for companies which are profitable and undervalued, right? So essentially, what we have done here is that here again we are showing market adjusted return, but these returns are calculated over a 3-day period for every company around their earnings announcement day. So we took all these BSE 500 companies, we got their earnings announcement date every year over the last 16 years, and then we looked at the 3-day returns of these companies over the benchmark, right? Essentially, what we do is we again form the portfolios in September every year, like I discussed, in the previous slide, and we hold this again each of the portfolios, each of this quintile portfolios again for 1 year, and in the next 1 year, 1 year hence, we look at the 3-day returns, excess return of these companies around their earnings date. So, for example, if you are taking a company, right, and you're included it in, for example, in your quality at a reasonable price portfolio, say last year in September 2022, we would look at the returns, the 3-day returns around the earnings date for that company when it announces its 1Q24 results. So essentially 1Q fiscal year 24 results. So I'll say somewhere it is they come out with that result either in June or July. So we'll look for those 3-day. We'll calculate those 3-day returns, and then we will keep on doing this for all the quintile portfolios for all the companies in these portfolios, and we'll do this over and average all these numbers over a 16-year period. So what happens, right? So what we see here is again, we can see that unprofitable overvalued firms, like in the top left box, experiences the negative earnings, negative excess return around the earnings announcement date, right? Again, the average excess return is around minus 0.5%. Remember, again, these are excess return only over these 3 dates. So if you are somehow worried that this 0.5% seems too small, again, remember that these are again returns measured over 3 days. These are not annualized or anything, right? So minus 0.5% for companies which are again, which are unprofitable and expensive, they experience a negative earnings surprise, right? Or a depreciation in returns, or a negative alpha, around the earnings date 1 year after these portfolios are formed, right? And again, this is consistent with market revising its overly optimistic expectations about these firms when they announce earnings. The opposite true, for companies which are profitable as well as undervalued, and they experience an average alpha of around 0.05%. So, similarly, what we have seen in MeritorQ is, we generally see that, again, for most of the companies we hold in the portfolio, we would see positive excess return on an average around earnings announcement date compared to other companies in the BSE 500 universe, right? So, and again, maybe a couple of other observation is, which kind of, spring out from this, this table is, value traps, or, companies which are, again, like I said, undervalued for a reason. Those companies again experience negative, returns around the earnings announcement. Again, that's no surprise, right? Because again, these are companies, which are undervalued for a reason, and generally what you see is, the fundamentals keep on weakening, and generally these tend out to be falling knives. So never good, investment opportunities for any investors. So, and also what you see is, again, across every value quintile, earnings announcement returns are larger for companies in the highest quintile of profitability, right? Than for firms in the bottom quintile of profitability. So again, I'm talking about the rightmost column, right? And as you go from uh, you know bottom to the top, right? So the what it seems is companies which are most profitable generally have positive alpha, deliver positive alpha around the earnings announcement date, right? Um, and especially companies which are overvalued, right? Per our measure of valuation, which is based on price to free cash flow, uh, those generally, and which are most profitable, generate the highest alpha. In this case, around 30 bips. Around the earnings announcement date. So what this tells you is, again, this is a theory, again, nothing related to MeritorQ, is that this could be due to that market doesn't realize the or underestimate the longevity or the future growth in free cash flow of these companies, right? The companies which are in the top right corner, right? And again, we are not looking at growth in free cash flow or longevity here. At least, that's not part of the matrix here. But that's a theory that maybe the market underprices or underestimates, the longevity or the free cash flow growth of these companies, and that's one of the reasons. It's surprise. It's positively surprised when the earnings, are good for these companies, and the alpha is consistently positive, right? So, in summary, again, to just sum up what we discussed, right? MeritorQ strategy, which is to select again quality companies at a reasonable price, which is again, like I said, it's just your bottom right quadrant, which you have discussed till now, allows long-term investors to benefit from correction in mispricing and subsequent reversion to their healthy fundamentals through a systematic and long only approach. Right. So I think that's all from me today. Alok, over to you.
Thanks, Christian. This is pretty useful. Very crisp message is what I can understand out of it. So we already have a few questions. Let me start with a basic one. So term valuation is very subjective, right? Different people might have different uh, understanding on how to calculate valuations or how to value a company. How do we explain that the valuation metric which we use in Meritor is probably the best, not the best, but one of the best? Is there something that our viewers can understand here?
Sure. So, see, valuation is, again, there's no such thing as a perfect valuation technique, and valuation nearly almost always is subjective, right? Because it's based on a set of assumptions, usually, and also based on the expectations of investors, right? And those expectations are mainly growth expectations, and other expectations like how profitable the company would be, what would be the future prospects of the company, right? In some ways, right? So everyone is trying to predict, right? So, and because there is prediction involved, because there are expectations involved, uh, so inherently it's a subjective exercise, right? So no valuation technique is perfect, and again, investors use different valuation techniques. That could be, you could use relative valuation. In our case, we have settled on price to free cash flow, and that also we are looking at relative price to free cash flow. And we have explained in the previous webinar why that is a good valuation technique, and mainly because again, just to maybe rewind, mainly because free cash flow is the most fundamental metric, again, metric, or a single data point nearly all investors look at, right? And the present value of any firm is basically or the price of any firm can be summed up as nothing but the present value of all its future cash flows, right? So free cash flow in a way is a is the most fundamental metric, again, which drives the share prices of all companies. And also free cash flow is comparable across companies, right? And we have, again, we took examples in that webinar why that is so. Unlike other relative valuation metrics, where differences can crop up simply because of the nature of the business. So again, price to free cash flow, for all these reasons, we believe is it's not perfect, but that's the nature of valuation. But it comes very close to being the ideal metric, on which you can measure or compare the valuation across stocks.
Right. So there's one follow-up question, that how a cash flow can help you understand whether the company is good or bad. Can you quickly elaborate on that in a couple of minutes?
Sure. So look, I mean, if you think about earnings, right? So the problem with earnings is it's an accounting construct, right? So earnings, again, we are looking at revenues, we are looking at expenses, operating expenses, and we are looking at other non-cash expenses like depreciation, amortization, so on and so forth. When I say earnings, I'm talking about profit after taxes. Now, all this, right, whether it's revenues or expenses or depreciation, essentially these are recognized by the companies using accounting conventions, right? So, if, for example, something like depreciation, for example, it depends on the depreciation policy being followed by the company, right? In many cases, company follow certain depreciation policy just to optimize their tax payout, for example, right? How much taxes they have to pay to the government, right? So, what I'm coming to say is, again, the earnings or the profit after taxes which you see, it's an accounting construct, right? It doesn't talk about how truly profitable the company is, and there's no way for us to know as investors whether the company is actually generating money from this core operations, right? What we try to do, when we use cash flow is, it's because cash is king, right? Because when you have cash in your bank, what we try to do is we are focusing on cash flows, right? And we are looking at cash flows again, after the company has paid its operating expenses, it has paid its working capital expenses, and also capital investments which it needs to sustain and grow its earning, right? So again, we are taking account of all the we are removing all non-cash expenses, all accounting related distortions, and we are recognizing all cash related expenses which is necessary to run the business, right? So in a way, that free cash flow is if you're looking at companies which are generating positive free cash flows consistently, right? Again, that consistency is also important. What that is telling us is, these are profitable enterprises, which are generating money, right? Real money from their core operations year on year. And again, like I said, right, this money is available to be either to be distributed to investors as dividends, or it is available as an option to companies to start new ventures and to do further, right? Further expand their business operations if that is required. So again, if you think about anything, any one metric which which investors should look at, which is really relevant from an investor point of view, we think it is free cash flow. And by the way, like I said, free cash flow is what is used to impute the value for the company. So like I said, the share price or the market cap of a company or the valuation of the company is nothing but the present value of all its future cash flows, right? And of course, there is growth, assumptions built into those cash flows, but it is nothing but this free cash flows projected into the future.
Got it. Yeah, so next question is, how is a general quality at reasonable price portfolio different from Meritorq?
Right. So, like I said, this the quality at a reasonable price portfolio is an example we used, right? Because we just took all the 500 companies, divided it into the 4 quadrants, and the quality at a reasonable price portfolio has around 125 stocks roughly, right? So there is no screening steps which we have employed here. right? In MeritorQ, like I said, we have the leverage, consistency, as well as the forensic screen, which we employ, in which we filter out unnecessary, unwanted stocks, and we do the selection on the screened universe, right? And there are reasons, we have explained in the previous webinar why it makes sense to select from companies, which have passed all these filtering steps, right? So which is not what we have done here. So that's the difference between the qualitative reasonable price portfolio which we have discussed here, and actually what we have implemented in Meritor.
Okay. So next question is on slide number 5. Uh, the two-year holding period is highest. Sorry, 2-year holding period has the highest 3-year return. Then why do we have a 6-monthly rebalancing schedule? Why not rebalance it once in 2 years?
Right. So, I mean, in a way, if you think about it, and is this question or again in connection with Meritor, what we're doing in Meritor?
Yes, correct.
Okay, so I mean, in a way, if you think about it, right, like we said, the average one-way turnover which we see in Meritor is around 50%, right? And this is the average, annualized one-way turnover. And this includes, like we have said before, not just, the stocks, exiting or entering, but also includes the changes in the weightages, right? So 50% turnover, roughly, if you think about it, your portfolio will get turned over once in 2 years anyway, right? So, and that's what we have seen in Meritor. Even though we rebalance semi-annually, on an average, once the stocks makes it into the portfolio, and I say again, on an average, right? Once the stock makes it into the portfolio, it stays in the portfolio for at least 2 years, right? So again, on an average, it stays for 2.5 years. That's what we have seen. So in a way, it's already happening, right, in Meritor. Even though the rebalancing is done once in 6 months, we end up holding, on an average, we end up holding a stock for at least 2.5 years, right? So in a way, that's already happening. And again, I don't want to again confuse this, the results we have shown here versus what we are doing in Meritor, right? Like for the reason I told you for the previous question, because the construct is different. And again, we are selecting from a screened universe, not from the investment universe of 500 stocks.
Right. So a follow-up question on this. We mentioned about a point that during the earnings, closer to the earnings, the price movement or the returns from this portfolio uh, might be higher. Do you think that makes a case for quarterly rebalancing in Meritor? Currently, we have a 6-monthly rebalancing.
So look, I mean, the reason we went for a semi-annual rebalancing, and we have emphasized again this point again and again, that again, we have looked at different options when we launched the strategy, and we, based on our research, we felt that a semi-annual rebalancing gives you the best trade-off between incurring too much churn, at the same time, maximizing your risk-adjusted return, right? Now, a quarterly rebalancing, can be considered, but in future perhaps, right? But that needs to be justified by our research, right? And I think I've also explained this, when we had launched the strategy, that the rules in the strategy, they are not static, right? And we do keep on reviewing these rules. We keep on, doing the work on, our research on, what's working and what, might work going forward. And based on that research, if we feel that a quarterly rebalancing is required going forward, we'll do it. But any changes, right? Any or all changes would be based on, again, will completely be data backed. It will will be justified, will have to be justified by research. And of course, it has to be reviewed and vetted by, the investment, by everyone in the investment team. So again, this is, a process which we keep on doing internally. But as of now, we have a semi-annual rebalancing, but going forward, if we feel that a quarterly rebalancing is required, we'll see, we'll review it.
Sure. So one question on slide 4. Uh, so it seems like it's fairly easy for investors to beat the market using quantitative techniques. Do you think such a strategy should continue to outperform going forward as well?
Right. So I think I mean it's a valid question, but remember that again, markets are not efficient, right? We might like to believe that again, everything, all the information is already implied in the current traded price of all, securities, right? And if that is the case, then I don't think our profession would be there. But there is uncertainty, right? That's a reality of the world. And what the why the prices fluctuate is because of this uncertainty about the future business prospects of the company, uncertainty about the growth of the company, uncertainty about so many things, right? Because the world is dynamic, right? So because of this, prices fluctuate. And and because again the markets are not again being driven by machines. We are all human beings. Again, these are by market participants are all human. And there is almost always this tendency to overshoot and undershoot, right? So not only is there uncertainty, the people who are taking decisions on that uncertainty, they are also themselves guided by different behavioral policies. So again, what that means is there is almost always, right, irrespective of the time, whatever stage of maturity of the market you are in, as long as you have markets where there are human beings who are the market participants, who have their own behavioral policies, and as long as the markets are not perfectly efficient, you would almost have this opportunities, right, where prices will undershoot or overshoot their fundamentals. And there will be opportunities again for strategies like this, right, which take advantage of this undershoot in our case, and benefit, and others, so that investors can benefit from this I would say market mispricing, right, which we have discussed. So yes, I mean, it seems obvious, it seems easy to exploit, but there is no reason to believe that going forward, this should not be the case, right? Because, like I said, mispricings are the reason you see market prices keep on fluctuating, right, day on day in and day out.
Correct. Correct. So next question is on the last slide. So we have shown that unprofitable and expensive companies underperform the markets considerably. Now, how can a general investor take advantage of this situation?
Okay, so you mean to say that the box on the top left, right?
Yes,
The
correct.
unprofitable and expensive companies. Okay, I mean the simplest and the most straightforward way is to short these companies, right? Because essentially what we are saying is the share prices of these companies are above the fundamental value. So the only way to take advantage of this is to short these companies. Again, we would have loved to again short these companies if it was possible for us. But because MeritorQ is a long only product, right? Which we have said, and we don't employ any leverage. And in our case, because it's an advisory product also, we cannot employ, we don't have any way to, short these companies or benefit from shorting this particular bucket of companies. So for now, at least, we don't have any way of benefiting, from, this quadrant of companies in MeritorQ or in our existing strategy.
Right. So in fact, I can think of if an investor can just avoid getting into these kind of companies, that itself might benefit a lot of investors.
Well, absolutely, right. Just focus on the bottom right, which you have kept on saying, right, because that has the lowest risk, the lowest forward-looking risk, and the best forward-looking return, right? So that's an ideal place to be for anyone, especially for investors, retail investors, and nearly all investors, right? If you're focused on generating returns.
Got it. So there are two, three related questions. For example, somebody wants to put in fresh money. So he's asking whether he should do it on a lump sum basis or he starts with a minimum amount and then gradually increases the amount. That's one. On similar lines, there's an existing investor who has invested some amount of money and he's asking whether it's a good time to top up.
Okay. On the first question, so if I believe the question is basically, should we invest at lump sum now or in blocks, right? So look, I mean, it's completely up to that particular investor on what your situation is, what you what is your objective when you're investing this money. My suggestion would be though is that to make that initial investment, the minimum initial investment, and keep on topping it up at regular intervals if required, because one, it helps you to average out your investments, right? You basically the purchase price, right? Because people keep on again even though I'll tell you, or anyone in the team will tell you that there is never a good time to invest in markets. There's almost always this question people have that whether this is a good time, or whether it's overvalued, undervalued, so on and so forth. So to get rid of all those worries, you can do this regularly, or just average it out in 3 or 4 installments, right? So that's one option. And also, I think we have said this in the previous webinar, investing regularly, even if it is small amount, breeds a good investing discipline, and almost breeds that habit. So that's also a good aspect. So I would suggest just stagger the amount, right, if possible. Maybe over 3 or 4 installments, right, after making that initial investment. And the second question was, Alok, if you can just repeat.
So somebody has already invested and he's asking whether it's a good time to top up, considering
Yeah, I
the
mean, it's
recent correction.
like I said, I mean, I'm not a believer in market timing. Where again, in Marcellus or even myself, right? And I say this because we have lived through multiple cycles, right? And again, timing is not relevant for investors, I believe. Who have at least a 3 to 5 year investment horizon, and that's the minimum horizon you need to have in mind. Have the patience to stay invested when you invest in equities as such, right? And it's no different here in MeritorQ. So, as long as you have that investment horizon in your mind, and you have the patience to, sit through that, the entire investment horizon, regardless of the volatility you see, I think you can go ahead and, top up now. Or, if you want, maybe, wherever that, gives you more mental comfort. But I would suggest, if you have the money, and if you feel, and that's just staying in your bank, just earning maybe the savings rate, it's probably better for you to invest or top up instead of waiting.
Right. So again, a couple of related questions. So one gentleman is asking whether he can get in and get out of this strategy, depending on probably the returns, what he earns during the course of this investment. And the second one is because we rebalance every 6 months, uh, is it advisable that they can get into the portfolio in between, not at the start, not exactly at the start of that post rebalancing period, but during maybe 2, 3 months down the line after rebalancing?
Okay. The first question was, again, just to repeat,
So maybe getting in and getting
whether
out
it's possible to
of this
get in.
investment.
Okay. Look, I mean, this in small case you can subscribe and unsubscribe anytime you want, right? It's completely up to you. It depends on how much you like the service we are providing. It's an advisory service, right? So it's completely up to you. You have the full freedom to do whatever you want. And like I said, we don't get in advisory, we don't get your money, right? The stocks are bought and kept in your demat account, right? So you have full control on what you do with those stocks. Now, to answer that question more specifically, you know, look, I mean, like I said, right? If you are thinking of investing in this strategy, please have at least a 3 to 5 year investment horizon, right? It's absolutely a must. And if you're just investing in this, just to maybe earn some returns over say a 1 or 2 year horizon, you're more likely than not to be disappointed, right? Because this strategy, like all other equity strategies, will go through its share of drawdowns, disappointments over short run. But like I said, right, based on the factors, or based on the characteristics or the kind of companies we select in the portfolio and the whole portfolio construct we have, our aim is to again maximize uh, the compounding of investor wealth at least over a 3 to 5 year horizon, and you need to give enough time for that to happen, right? And it will only happen if you stay invested for 3 to 5 years at least.
Right. Thank
And
you.
the second question was, Alok, if you can maybe.
Yeah. So since we are doing 6 monthly rebalancing, uh, is there a case that somebody can get into 2 3 months in between? So, for example, we did the latest rebalance in October first week. So, if somebody
Mhm.
wants to get in into around December or January before the next rebalancing happens.
Uh, I mean, I don't see any reason why you should. I mean, of course, it doesn't make sense for you to. I mean, if it is a question on when they should subscribe to the portfolio on small case, so it doesn't make sense to subscribe, say, I mean, maybe a couple of weeks, just before the rebalancing, because you'll most likely get the old portfolio, which you will probably need to churn again, right? So maybe that's not advisable. But apart from that, maybe that small window, right? Just maybe 1 or 2 weeks before the rebalance date. Any other time is a good time, right? There's absolutely no reason, why you should, wait or try to time your entry or exit. Uh, because what you essentially get is the model portfolio. So the advisory portfolio, which you will see on small case, essentially gives you the model weights and the model portfolio, and that's same irrespective of whichever date you decide to invest with us. So I don't think timing the entry or the exit has any meaning.
Right. So, what I understand and what Krishnan also mentioned earlier is, so if you have surplus money which you don't require, say for the next 3 to 5 years, then it's ideal to invest in equities. Uh, if you are So this 1 or 2 months here and there probably will not make much of a difference over a longer period of time, is what we are trying to communicate here. Right. So there are some execution related questions. So let me quickly answer this. So just for the benefit of all, this is a portfolio which is listed on small case platform for the ease of execution. All you need is a trading and demat account and a Aadhaar which is linked to your mobile to get the OTP. Uh, your trading account should be with a broker which is listed with small case. Small case has around 16 odd brokers listed. All the prominent brokers are present there. So you can visit the Marcellus website, and through Marcellus website you can go in and invest into this strategy. It will take less than 10 minutes to start your investments with us. Uh, you have to first subscribe to the portfolio. Once you have subscribed to the portfolio, then you will get the portfolio on your screen and you will have to make the investment. You will have to execute the investment by yourself, which also will be executed via the small case platform. Once you log into the small case platform using your broker trading and demat account credentials, you will be able to execute that seamlessly. So post subscription, the next step is to execute these trades in your small case account. If you have any product related queries, you can reach out to us on help.ie@marcellus.in. If you have any execution related queries, you can write to smallcase at help@smallcase.com. Or you can also call us on our registered numbers. Yeah, so Krishnan, we do not have any further questions. We can, if you have any closing remarks.
No, I think, like I said, I mean, we have approached the 1 year mark for the strategy. So, again, we keep on, sharpening our, tools and, how, our research and making the strategy better. But I'm really grateful to, everyone, right? All, current investors, all the listeners on this call, for their support till now.
Thank you so much, Krishnan. With this, we come to the close of today's webinar. We hope the attendees were able to get some insights around our thought process or around why valuations and quality go hand in hand, and how it can be useful to create better returns for any investor. As I mentioned earlier, if you have any queries, you can reach out to us on help.ie@masters.in, or also you can visit the FAQ section on our website. So thank you everyone for attending today's session. Have a great evening. Thank you, Krishnan.
No.